you may have never known.
Is trying to avoid crashes, market crashes, hurts more often than it helps. Market timing is a mistake, not a method.
And just to clarify and describe to you guys exactly what we mean by market timing, because I think a lot of people have the expectation that this is what you do as an investor. You try to time the market, or if you have a financial advisor, this is what they're supposed to do for you. But let me describe to you what it is, and then I'll tell you about why it doesn't work. So what it is trying to get out of the stock market before it dips or crashes.
Sell at the top.
Which nobody knows when it's going to dip or crash.
That's right.
And then being able to get back into it before it comes back up. So basically, you're trying to avoid the painful parts of being an investor. It doesn't work.
Right.
Literally, people who are professionals at it can't time it right. There's nobody has a crystal ball to know when the market is going to go down to get you out in time. And the other problem is that if you're out, how are you going to know when to time it right to get back in? So what people end up doing is they end up getting nervous as the market's going down, and they sell low as the market's already gone down. And then they're not comfortable enough to get back into the market until it's gone up high enough to where they're at a level where they're like, okay, well, maybe it's done going down. And then they get in at a higher price than what they sold at. And
they'd have been better off if they just stayed in and wrote it down and wrote it back up.
Yes, and there's actually been a lot of studies done on this subject. I'm going to show you, we've talked about this before on our webinars, and I'm going to show you, I have a new chart for you.
A new chart?
But it shows the same, concept, okay? So this shows the value of if you had invested $10,000 in the S&P 500, so say in an S&P 500 index fund, in January of 2003, and this goes through December of 2022. So
20 years.
About 20 years. If you had just held on to that and stayed invested all the days, you'd have almost $65,000.
$10,000 would have grown to almost 65,000. Is that right?
Yes, without having to add any money to it or anything.
Wow.
What's something that I want to bring up that's really important is we had the great financial crisis during this time. And we also had when the market went down like 37%. And then we also had COVID during this time, and the market went down about that percentage in a matter of a month.
Right, month and a half.
Also, so those were very scary times for people, a time where a lot of people wanted to take their money out of the stock market, and a lot of people did, which was a mistake. Now, if you had initially invested this money and taken it out and missed 10 of the best days in the stock market, your return would be less than half of what it was if you would have just stayed invested.
Less than $30,000.
Now, the important thing about the 10 best days in the market are a lot of times the best days of the stock market are piggybacked right next to the worst days of the stock market when everyone is freaked out and selling. Okay, so let's look down here at the 10 best days of the market. All of them fall in 2008, 2009, and 2020. Those are all of the 10 best days in the market. Those are all the days when people were freaking out and wanting to be out of the market. Those were the best days that made the difference between this return and this return. And if you stayed out and missed more of the best days in the market, obviously your return gets even worse. Yeah. So you're better off just holding and staying invested. There is one time that we would tell you that it's a good idea to try to time the market. And that's never to be defensive about trying to time the market. So it's never trying to get out of the market. It's about getting in the market. And you can try to time the market offensively if you know that everyone else is fearful. Then it's a good time if you have some cash sitting on the sidelines to buy. That's like the Warren Buffett strategy that you hear about. That's the only time that it's good to time the market.
Yeah. He says to be greedy when others are fearful.